Hello Anubhav, how are you?
I'm good, Puru. How are you? Good to see you.
Yeah, good to see you. How was the break over Christmas?
Perfect. It was really relaxing, I believe. I think everyone must absolutely needed it. So happy New Year to everyone. Those who have taken a break or probably on a break already as a part of the New Year's. But I think it is good time for everyone to reflect back on the year and enjoy the break before they get back into the grind again.
Yes, absolutely. Happy New Year, everyone who is listening to the live podcast or looks at the recording later on. So today's podcast is a special one, first one of the year 2025. Yay! I hope you all had a lovely holiday and have some good time with the family and all excited for the year. We are very excited at Find My Real Estate, of course. But this podcast, I thought we should do together along with Anubhav because because we are beginning the year. It's important to get into the game straight away, understanding how the markets are positioned. And I would love to hear from you, Anubhav. How do you see this year spanning out from multiple angles?
Yeah, look, I guess before we dive into this year, just as a reflection of 2024, the markets have been quite distributed in terms of the growth factors and what they have posted over the whole calendar year. We've had obviously Perth, Queensland, and South Australia being the runners on the board with double-digit growth, from all the way from 11% to close to 20%. If you talk at specific suburbs level, the growth has been more than even 20% in quite a few areas that have been achieved. So overall, I think if people have invested in the right markets, they have seen a good growth over the year, in spite of interest rates being very high. Yet, if I look at the state of the nation at the end of the December quarter, we've had a slowdown over the last two quarters compared to the entire year, or maybe if you compare those quarters from the previous 12 months, then there has been a decline in rate of growth. Melbourne's obviously been struggling. Sydney is probably behind that. We've got Canberra and other markets sort of almost positioned at par, but the three states, as I said, have done phenomenally well. Now, the rate of growth has obviously reduced even in Perth or in general WA, South Australia, and Queensland over the last quarter as well. And this is data from October, November, December. So at the national level, there has been a first time a 0.1% decline at the national level. And the last time we saw any decline was back in February 2023. So between all this time, we've had a good rate of growth. Properties have been going up, but now we've seen sort of a marginal decline. But I'm not too concerned about it in 2025 because there is a high optimism that the interest rates are going to come down this year, and as early as maybe even next month. Uh, we've got CBA who had originally projected interest rates to come down end of December, and that moved to February. And we had the other three major banks talking about that happening in May. And recently, just a few days ago, we've seen some news come out from ANZ who's revised their view, and they believe that the first interest rate cut will happen in February too. So
Okay,
the,
that's good
the
news.
fourth split at the moment, yes. I mean, regardless, whenever it happens, the point is that it is all priced in the market. So the very first 6 months of this year, so that should give a lot of confidence to the consumers to get ready and do something. If they haven't taken action in previous few years, as far as growth is concerned.
No, that's good. And hopefully, this should encourage a lot of people to move from a position where they are stuck into uh, a fear mode or rather than caution mode. What do you think about the unemployment or the outlook of economy in general? Because while talking to a lot of my clients, they certainly say like, look, we are ready financially, but we are
Yeah.
hearing about lays off happening and all these things. So, what's your
Yeah.
view on these things? Is there an outlook for that, and what do you think from a investor perspective?
Yeah, look, I mean, it's sort of a split between depending on which industry you're talking about, but there'll always be layoffs and there'll always be new hiring that's happening, depending on the industry again. But overall, I think Australia is is very strong financially. That way, it knows what it's doing. I don't think the government is going to let this go into recession at all, no matter what happens globally. Yeah, but at a point in time, there may be more layoffs than what had happened. And usually we have seen that towards the end of the calendar year, usually there is a refactoring that happens with a lot of companies. And people do get that fear mode, what's going to happen. And the second time it happens is, during the financial year end when people are realigning their books and so forth, so they can post, their returns accordingly, especially ASX companies. So I think I'm not too concerned because a lot of that layoffs and slowdown in businesses is to also do with the interest rates, and it is directly tied to that as the
Okay.
cost has gone up significantly for everyone. But and this is the whole reason why RBI is behind the scenes to make sure that they can bring the inflation back to the 2 to 3% band, so that we're not seeing this sort of high inflation that we've seen in the past, and that is quite digestible to keep things balanced. So I think we are nearly there. So therefore, the optimism has gone up from the banks to really price that in for the next month for a couple of the banks that we have mentioned. So I think as interest rates come down this year, that should also give more confidence to the businesses, and there should also be rehiring happening as well in certain sectors that are losing that momentum.
Okay, great. So, I think it sounds good to me, and hopefully, this should give a lot of confidence to people who have been waiting for it. What about the home buyers market, specifically for them? Which areas do you think are going to be the most practical places for first home buyers?
I think the first home buying is they are quite active at this stage,
Hmm.
given that most of the first home buyers, especially in Sydney and Melbourne, there are huge opportunities right now, whilst others are sort of sitting on the sidelines, especially investors. Home buyers
Hmm.
have been quite active in the market and trying to secure a bargain if they can. And there are a lot of properties on the market in the metro cities that people can get access to. But I think they're also gripped with fear of what's going to happen with high interest rates right now. So it's a bit of a mix between the two, but I think they're perfectly, as far as the window is concerned, it is perfectly positioned right now for home buying. Where there are maybe in the right places where they want to live with the good schools and good areas and good infrastructure, then they can get their hands on properties that otherwise in heated markets is really difficult for first home buyers to even go and stand in the auction and try beat the investor market, for example. So those who are still sitting on the fence, I would probably say that this is your opportunity. Like, if you have the money, just make the move now.
Okay, thank you. So, look, Anubhav, I want to focus a lot on the topic and the theme for today. Hopefully, you
Yeah.
can give your insights on that. And the main topic we really want to go a bit deeper into it is: are there positively geared properties in high interest rate markets? Because I do talk to a lot of brokers, accountants, and even our own clients at FMRE Real Estate, but many of them ask consistently about positively geared properties, and would be good to understand what a positively geared property means to begin with, and at the same time what does negatively geared property also means.
Okay, yeah, that's a good one actually, because a lot of people, miscalculate how they look at positive and negatively geared properties. So to explain this, because negative gearing is so common right now, and it's already happening in most of the properties that people are even buying now through investments as well. I can explain that in a simple language. So let's say uh, if the rent that is coming in from the property is not enough to cover the direct expenses of the property, be it property management, maintenance, rates, cost in relation to utilities, and land tax, and plus obviously the interest component of the loan is cannot be covered entirely by the rent that you're getting, then the property is deemed as negatively geared. So
Okay.
to put to put that in numbers, if you've got 25,000 rent coming a year, and the total expenses, direct expenses plus the interest component of the loan that you have taken is 30,000, then you're negatively gained 5,000 for the year. And vice versa, positively gained means completely the other way around. If your income, your rental income covers all these costs, including the interest component of the actual loan, then that is a positive gear property, which means the income actually gets added to the entities, whether it's an individual or a trust. Once you sort of distribute that income, it'll get added to that particular person's tax return, essentially. So I'm not an accountant, but that's usually how it gets added on as an income coming from assets to your other income streams.
All right. So hang on. So doesn't it mean like, so what's the loan percentage we are talking here? Because if I put more money from my own pocket, my loan will be less naturally. So my interest might be less. Or if I've already paid a component of my loan. So it can be
Yeah.
a variable definition of the same property depending on when you are looking at it, isn't it?
Yeah, so the percentage of negatively gained will depend on your LVR essentially, so your loan to
Hmm.
value ratio. In most cases, 80% is majority of the people take 80% of the loans, and 20% comes from their pocket as a deposit plus
Yeah.
cost, of course. So this is the interest calculated on the 80% of the loan essentially.
Is it an industry standard?
It is mostly industry standard. In some cases, people also take the cost of the actual cash that they put in as well to
Hmm.
factor that the interest, because a lot of people might use equity as a position from the
Yes.
existing
Correct.
properties and use that as a borrowing as well. So pretty much they're not just borrowing the 80% against the new asset, they're probably borrowing 109%, which is the entire cost. So there's not a single dollar from their pocket, everything is borrowed. In which case your negative gearing is going to be far higher as well.
Yes. And then is it industry standard for residential properties? What about commercial?
It is the same. So the terms don't change.
Okay.
However, in terms of what is a for claiming negative gearing against your taxes, there's no change there at all. It's just individual way of looking at how I look at negative gearing versus positive gearing can change depending on whether you only factor in the direct 80% of the interest of the loan, that is of the asset you're buying, or are you
Yeah.
considering the 9% of the total cost? But if you're using your cash, which is sitting in the bank, to feed the 20% and also the cost in terms of stamp duty, conveyancing, and building and pest and other settlement costs related, then
Hmm.
that you cannot claim any interest against that because you haven't taken loan against it. But if it comes from equity, absolutely.
Okay. Got it. So it's a
It should
choice.
be
Yeah.
it should be
Go
going
ahead.
to the accountant for that
Yeah.
question.
A good accountant will always resolve this.
Yeah.
Okay. So I have a few questions which I received earlier, and I thought I'll keep some questions to ask from my side as well. So, in a high interest rate environment like we are right now, how do property investors typically react? And what challenges do they face in terms of cash flow?
This is actually the most common problem right now we are seeing. So if you recall back in COVID, the interest rates were close to around less than even 2%. And most of the properties were positively geared, which meant that it was easy to get more loans and people were able to live their lifestyle the way they wanted. And there was cash flowing around. So people used the money to enjoy their lifestyle as well. Now, the same properties that they're holding over the years, of course, the interest rates have gone up quite strongly up in the last few years, and that's obviously turned the whole situation in a negative position. So people are those who have had or bought a lot of properties or deep into borrowing, then currently their lifestyles are also getting impacted. So some of them have to forcefully release properties out of their portfolio, and others are still trying to grapple through, trying to see if they can refinance and get something out of that, to see if they can still continue to hold properties, because a lot of people are emotional about the properties, and and most people don't even know if the properties that they're holding are good enough to hold for the future. But that's the current state of, most properties being negatively geared that people are holding. Now, with that, even people who are buying new properties right now, if it's a standard buy and hold type property, established properties that are on a big land size, that type of properties, established properties that we buy, tend to also be negatively geared as well. So people who are building portfolios now in this high interest rate environment, let's say if you buy a $500,000 property with a rent of 500 per week at this stage, properties are nearly, close to anything between 12 to 15,000 or even 17,000 negative for the year, depending on whether it's an 80% loan or 109% LVR, as we discussed earlier.
Yep.
So you have to really work this into the cash flow to see, can they hold that property? Should interest rate either go up or stay the same?
Yep.
And work out how many properties can they buy. So one of the things is try balance that with another strategies, so that you can try, do this with multiple properties and still be able to hold that by balancing cash flows. So that's the kind of advice that a professional should be giving, that what are the options in the market that will allow you to be able to balance your portfolio without losing growth at this stage.
Yeah, it's a very interesting thing you brought up, because the whole positive gearing, negative gearing understanding of investors or anyone has three components to it, right? So one is the type of assets you're thinking to buy or holding or will buy or release, right? Second is how is your tax structure to manage that as a choice which you have to make as an investor or whoever you are, right? And the third is your debt planning around all the three. So what's your view on the three components? I know you are not a broker or an accountant, but from your experience now, what do you see from all the three things?
Sorry, from debt planning and tax planning. I
Yeah,
think the
because
thing is,
hmm, go ahead.
now you were saying, sorry, complete your
Yeah.
question.
So the first thing is from an investment strategy perspective, then how to put a consider a tax structure around it, and then the third is the debt structures around it to manage that impact of uh, heavily negative gearing properties or lack of positive gearing properties in your portfolio, one or the other.
Yeah, so look, I mean, the first thing is to review exactly. I think the step one is look at your current assets. You know what you've got. Is it really even making sense? Should you even hold these type of properties or not? Right? Because they seem to be emotional about them. Secondly, if the in most cases, most people are holding properties in their names right now, so they should be talking to the accountant. Should they decide to sell, what are the implications of it in terms of any and so forth. Um, but if you're looking to, if you have enough capacity now and still be able to buy the properties, then I think a good advice from an accountant can help you decide, and also in conjunction with a broker, to decide whether buying in your name is still a good idea, or should you actually be buying in trust, which basically means you're not holding the property, but they're all being held in the trust. So that can have significant benefits, and there are pros and cons to that to trust as an entity. But
Mhm.
and these are for another topic that we could cover, in detail, bringing in some experts to talk through that. But it has been quite viable option for people to manage their positive gear properties through trust, and manage tax effectively if that is the case.
Okay.
Right? From the property strategy perspective, I guess there are quite a few strategies that can be implemented to allow positive gear options to come into the portfolio if that's not the case already, right?
Hmm.
A lot of people, for example, at this stage, there are a lot of companies who are selling off the plan land and house packages, which we don't like at all. But they are advertising quite openly about reduce your tax, reduce your negative gearing through the options of getting tax back from the taxman, as part of the depreciation that happens along the way for newer builds and new properties. And most people get stuck into that sort of thing without realizing what they're getting and doing. But it is one way that is helping people right now reduce their negative gearing as they get huge tax cuts through, or get the tax back or refunds coming through the deductions that happen at the end of the year in their investment properties. Um, as a strategy of actually buying land house packages and building investments, I don't totally qualify that if it is just buy and hold, unless you're a developer building such type of product in the market for some other retail buyers to take it over. That's a different thing for profit. But as a standard buy and hold, it can be quite a bit of a costly affair on something which is on a very small land size. So so that's one thing what people are doing. Secondly, the other flip side of the coin is that if you are in the established market type of properties that you're buying, then a lot of people are also looking at buying townhouses and apartments that are already established, which can to a certain extent reduce the negative gearing because the rents tend to be a lot higher, but you are also compromising on growth in most cases on the market and the location of those type of properties.
Hmm.
The type is without impacting land size, and if people are buying smaller type of properties or size of properties, 2 bedroom, 3 bedroom, in a big land size, but in mining towns or isolated towns where the rents are very high or yields are very high, then that's what is also helping people right now reduce negative gearing. Again, none of these we are recommending at all to our clients. We are not saying go buy a townhouse land, go do um, apartments or even buy in these remote locations with only single industry where there's heavy mining, as an example. None of these are being recommended to reduce the impact of negative gearing for any of our clients as such. So I hope I answered that question.
Yeah, it does. And I realize it's an encyclopedia in itself because depending on what strategy you have to invest, the overall thinking around positive negative gearing can be very variable. And also it probably depends on your uh, pay scales and what your current portfolio is, or you plan to make it to, right? So the whole thing has to be designed to the individual's need. The more I hear you, the more I feel that.
Yes. And I think it comes down to individual goals and then having an expert by you to re strategize the whole thing and see what would be the right strategy at any point in time. Even if it is SMSF, a lot of people are very inclined about buying in SMSF right now. We're not there to advise on SMSF, but if people come through to buy properties in SMSF, then there are quite a bit of restrictions of what you can do in SMSF and the type of properties you can buy. But if you cover the level of strategies that we are recommending to people and what we are doing on the ground is that uh, people can look at options if their current properties have opportunities where they've got a fair bit of backyard, and if the legislation in the state or the council allows them to, they can always add a secondary or an auxiliary dwelling at the back of their home in those investment properties that can allow for additional cash flow. It's like the granny flats, right? So Victoria has had this new change that came in December 23. So it's been more than a year now. And Victoria earlier did not, you could not build granny flats for investment purposes. You cannot build granny flats as a result. So people can utilize the backyards to put the small units in the back, have it installed. These come flat packed as well from different countries, and they can be installed anywhere as long as the council has the appetite for it. But already a national code to it, so you can use that. Or Victorian has certain rules around it. Actually, for that matter, every state has a rule around what you can put in your backyard, and council drives it. So make sure that is aligned. But you can do that to increase rents as well. Secondly, rent review is important. So if you haven't reached out to your property managers and your rent has been the same for way too long, you you can nudge them, and especially if you're coming up to a renewal, nudge your property managers to see if there's an increase in rent. Don't just take it on their on face value what rent they might tell you. Do your own research, and then maybe you have the opportunity to counter that. I've seen that in cases where on my own properties I would recommend a rent of and keeping it the same as last year, and they were very confident that we won't get a tenant. But then when I did my own review and I said, okay, well, actually I can get the additional $50, and we went with that view in the market, and it was in a few days it was taken up. So you never know who's renting, who wants to rent. So market is market, but there's always an opportunity to try that. So that's one thing. Secondly, apart from granny flats, if you're going in the market to buy, you can look for deal occupancies. Not that it has got huge advantage right now, because especially if the electricals are not separated, then there might be a problem with that, because you might have to pay the cost from your pocket, or any electrical bills that might come through, or even water charges. So you have to be very careful when you're buying duals right now. But block of units can serve you well to reduce your negative gearing at this stage. Another one, if you've got obviously properties, or maybe it might be an apartment or townhouse, and in a very good location where you can do Airbnb, then that could be a great option to look at how you can turn things into an Airbnb. So if you find someone who can manage that for you, then it can become a great strategy to turn a negative gear property easily into a positive gear properties as well. And of course, I mean, my all-time favorite is commercial, which is positive gate from the very first day itself. And we are buying a lot of commercial properties for our clients to balance their portfolios, even under $1 million, with high yields of 7% plus. They're not easy to find across the country, but if people are buying childcare centers, and that's great as well if they're flipping or whatever, but you're buying shopping centers with only 3%, 4% yields, warehouses for 3%, 4% net yields. I guess that's where the cash flow is constrained. But if you chase 7% plus type of yields that we are buying for our clients, as an example, then that can go into green and be more positively geared type properties.
Okay, very interesting. So I have a question regarding commercial, that if someone is taking equity to buy a commercial, for example, then their calculation has to be on the whole loan they are taking, like whatever down payment, because they are trying to take the down payment component from the equity. So the actual positive gearing has to be calculated based on the total interest you are paying, because as an industry standard, any calculation will be done on an 80% loan, as you said. But in reality, they might be 100 or 109% loaned. So is it really going to be positively geared or not, if that's the
So
case?
depends on the yields, of course, coming from the property. But I would probably say that if see, the whole borrowing concept, right, is an individual circumstance as such. So there are limitations with how you can go, what you can do. But if you take everything into consideration, like when I say net 8% plus in commercial, or 7% plus net yields, uh, the way the commercial terminology works in the market, uh, the the positive gate in commercial means that we're not taking personal finance into consideration. So we're not taking into consideration any of the interest component of the loan as such. So when they say net 7%, so let's say a property is worth $1 million, and there is a net 7% return on it, which actually means you're getting a net rent of $70,000 plus GST plus any direct outgoings of the property, right? So that 70,000 is your net return essentially. Now, what you need to minus out of that is the interest component, which is net yield, which will be far below the 7%. But you might still land up with either 0% or 1 or 2%, depending on how much loan you're really taking. But it is far better position than to be negatively net yields when it comes to residential, if you know what I mean.
Yeah. So it's interesting that even after paying the interest and all the other things, but this is again 0 to 2%, which you're saying is generally based on 80% loan, right? If it's more than that, then it's an individual circumstance and it may be more. Correct?
No, with 80, with 75% loan, because
75.
in commercial, usually the properties we are buying is somewhere between 70 to 75% LVMs, essentially.
Okay, no, great. Thank you. So I have a question from one of our viewers, Ram Velavar Tipari. Thank you. How to invest in acreages? Is it a good idea?
Yeah. We recently purchased 23 acres in Melbourne Metro, and there was another one that was available right now with Airbnb on 100 acres as well, which was off market sometime back. We didn't end up buying that, but acreages, you really need to understand that the land tax components related to that and what is the cost going to be and the income that you're getting from it. If it's a long-term hold, depending on your financial position, if you can hold properties for that long, let's say if your strategy is that I'm going to hold this for 10 years, I don't care how much rent I get out of it, I will be able to get, I can hold the property, then absolutely do it. But then if you are sort of looking at more like a short-term output to say, okay, I'm interested more in building the right type of portfolio, then you don't want to go and buy too expensive acreages as well, because depending on where these acreages, this can lead from $300,000 all the way up to even 10, 15, $20 million as well, depending on the locations and so forth. So be mindful of the budget. A lot of people buy acreages in joint ventures with other people. Again, I would be reconsidering whom I'm going in with, because sometimes these things in slow markets take a long time to sell as well. These are long, usually people who are buying acreages or those who are selling acreages, the settlement periods are quite long as well. So you got to just make sure that you can enter and exit with clarity in acreages. I like that as an opportunity, but it cannot be your first or second property. It'd be more like a lifestyle type of a property or something that you've got a vision that you can want to develop down the line, separate story altogether. But standard buy and hold, if I'm going to put a lot of my money just in one property, I would reconsider that strategy and maybe talk to the experts to really look at the position and guide and provide guidance like we do.
Okay, thank you. Hope it answered your question, Ram. If there's any counter question, please feel free to post it. So, in terms of positively geared property or a negatively geared property, you mentioned something about the trust or individual names. Now, I know it's an accounting question, and I get asked a lot of times as a first time investor, should I buy it in my own name or a trust? Now, I really tell them to talk to the accountants because they are the right people to tell you about it. But in your view, is there a mathematical way to arrive to that number? How to really conclude, keeping aside that we can't give advice or whatever, but what's the logical way to arrive to that number?
Look, I don't think there is anything logical, mathematical, logical way to do this. But what I can say is that when you're buying properties in personal name, especially when you're looking at building a portfolio, at some point in time in the future, when you're selling properties, it becomes you almost feel constrained of how to manage that capital gain that you actually got to minimize any taxation around it, right? And plus the exposure that you have everything in your names. And that worries me when people have too much assets in their names, right? And again, people might have different risk appetite to it. They might be hedging it in the right way, so that's okay. But that those are my main concerns. Also, borrowing can be quite limited because everything is exposed. Banks can see everything, as opposed to trust being the scenario where it's a family trust. My family is anyway covered. My wife is covered. My children are covered. Whatever assets are in there, they're not in my names, they're in the trust. So I get the asset protection, if something goes wrong automatically. Plus, at the same time, when that CGT event happens, capital gain tax needs to come into play down the line when I sell, if at all there is that capital gain on it, then I have the opportunity to decide who gets the money so that I can maximize my outcome on taxation essentially. So I think it's a very personal driven game. But if you're looking at a long term game and you are going to become an astute investor with multiple properties, the best way the 1% top 1% people do this is is do this in trust and do this the right way from the very beginning, right?
Hmm.
Um, I don't think anyone can disqualify that, regardless of the personal situation, but personal situations can dictate, and the risk appetite can dictate whether this is right for that particular person at that point in time or not, right?
Yeah, I
Especially
guess.
board.
Yeah. So my rate of saving each month pretty much is a capping number on how much I can really shell out for my out of pockets and how I want to treat it, right? That's how I looked at it. Um, but what you are saying is interesting as well, because you're almost saying that rather than seeing what's the end of the tunnel, you are actually towards the end of the tunnel and looking backwards towards the starting point, and then sort of imagine yourself getting those capital gains. And at that time, you don't want to be fish out of water.
Yeah, it's like as simple as the rule of when you're buying something, people normally look at the entry criteria, but no one thinks about
Hmm.
the exit, right?
Yeah,
And and if you don't have the end in mind, then you might be starting the wrong way itself, right?
yeah,
And therefore, a strategic conversation needs to occur to think through this a little bit in a bigger fashion. Like a lot of people say, I want to buy my name right now because I can get negative getting benefit because I'm on a very high income, right? 200 plus 250K. And that's a very common scenario we have with our clients as well. They're paying 45 cents to a dollar in tax, and they're like, okay, I want to save this 45 cents. But what people don't realize is that how much negative gear are we talking here, right? And if you put that number into perspective, like for example, as I gave an example earlier, that if it's a $500,000 property with a $500 rent on it, you're probably negatively around 15,000 a year, give or take, right? So let's say if you're 15,000 that you're trying to claim back in terms of tax at the end of the year on a income of $200,000 plus, you know, for every thing you're going to get only 45 cents back of that money, right? So is that saving $8,000 or 7,500 or $7,000, getting it back in the tax? Is that going to make a huge difference when you're on that type of salary? That's the question you should be asking. What should you be looking at? Investing in the right place for the very to start with, and the right type of strategy so that it can actually give you the right outcome, right? When you are building wealth, and the wealth is to be built from a long-term point of view to really allow the sustainable wealth growth both for yourself and for your children, you should be comfortable paying taxes. But legally, how can you structure the right way? There are professionals to help with that. So I would say, there's no advice here, but I would say go speak to a good accountant who can help you see the end and then advise you based on what your plan is going to look like. But you got to talk to your plan, because most people are, okay, you're buying a property, should I buy in trust? Then they're also looking at only that one property in your case. But if you tell them over the next 10 years, I'm going to buy 3 to 4 properties, right? And this is my plan. I'm going to buy some commercial, I'm going to buy Airbnb, I'm going to buy development. This is what it is. That's the type of capital gain I might be expecting. What is your view? What should I be doing? That the whole discussion changes, because now you give in a food for thought to your professional to give you their advice based on what your plans are. So it is very critical to plan that the right way. I have so many people that we talk to who at the very beginning are quite comfortable doing the person name because it is easy entry. There's no mucking around, there's no trust, there's no complications. Especially the first time investors, they can't even see beyond what we're talking about buying the first property, so let alone the structures. And then they buy the first one, then they buy the second one, and then mostly then they come and say, "Oh my God, I should have actually bought, the property in trust." Like recently, we had a client who's had a 38% growth in just 1 year in Queensland for their on their property, right? 335K property is probably close to around 480, 490 plus. And and if that type of property is in your personal name and you're going to hold it for the next 2 to 3 years with the type of return that is already getting from the property, how are you going to manage that type of capital gain, right?
true.
So you got to think through what you are really getting into and what are the implications of doing that. Another question that comes a lot to me, whilst we're on this topic of trust, is that okay, I have something in my personal name, I can move it in my trust, right? Yes, you can, but you may have to pay stamp duty again. So you probably need to speak to your accountant about that as well. And it's not probably not going to be worth next time with you again for the same property, unless you're really emotional about it and you really want it,
Understood.
right? So
Yeah, and
that's
interest, and
yeah, sorry.
interest, you can add your beneficiaries as your family members and all that. So definitely there are more things you can do. I know.
Yeah, in the
Uh,
family trust, your immediate family is already covered, yes. Like your children are already covered. So you declare the members, but yeah, that's what it is. Yes.
okay. And this is irrespective of the salary levels you are saying, because if someone is at a salary level of 400,000 individually, and for them it hurts to pay whatever percentage of tax goes to the government, and if they can have negatively geared, because I was speaking to a couple of investors who were saying, out of like as a couple, and they can be single investors as well, it's not to exclude them, but as an example, so the high earning uh, partner was keeping more negative geared properties, like more percentage of the highly negative geared properties in their name, and the low income partner was keeping high growth property percentages more in their name. Is there
Yeah.
a way to play around with the ownership structures, percentage splits, and all that as well, in
Look,
your opinion?
not for me to advise, but I think I just see that being a decision at a point in time. Salaries will change down the line, and the outlook to hold a property is not for 6 months or 8 months. So usually it is a long term. So no one knows what's going to happen in 4 years, 5 years, whose salary is going to be higher or no. So
Okay,
I like control over my decisions rather than making a decision today on something which I don't know what's going to happen tomorrow. You know what I'm saying?
fair
That's
enough.
just me.
That's the point of view. Yep, makes sense. So another thing I wanted to share, because we are on this topic of positive gearing in high interest rate and all that. So I was speaking to a broker friend the other day, and it was quite interesting. They brought up that as simple as getting your loans reviewed every 6 to 12 months with the same financial institutes can also, like, you just don't know, you can get a revised rate, and that can knock off a little bit of pressure. Or even just changing from paying monthly to weekly, your installments can significantly reduce your calculations on interest and everything in the loan. So if you're listening about it, viewers, please talk to your brokers, and maybe stick to some more frequent conversations. You never know where it can
Yeah,
take from your outcome perspective.
yeah.
All right. So I think we are approaching the 45 minutes mark. Uh, what are your top favorite positively geared property or strategies? I have spoken to you in person. I think the combination of investment property and commercial, whether you buy two investment properties and one commercial in a trust, that kind of thing was very fascinating. If you want to share your views on that, Anubhav.
Um, Look, I guess I just talk to individual strategies because I think we talked about commercial, we talked about dual occupancies, we talked about block of units, and how people are doing it standard with apartments and townhouses, which we don't recommend. But there's also another strategy which is Airbnb that I also mentioned for positive cash flow. There are two other things that people can look at. A lot of people are buying older style properties or they hold quite old style properties. Look at renovations, right? There could be cosmetic renovations that can help improve the value of the property. You might not have to spend a lot of money, but if cash flow is an issue, you can probably borrow some, maybe get some money out of your bank account because people are stashing money away in banks, but as to certain dwelling rate. So if you take the money 30, 40 grand on cosmetic renovations that can help increase the rent as well. Maybe if adding an aircon or just making life easier a little bit for the tenants if that is not happened can also help increase the rents as well in the property. That's one way to look at it. Another thing which is I'm very excited as a strategy is co-living as well. So rooming houses, right? What that means is that if I have a 5 bedroom house and with two bathrooms, uh, instead of actually letting that whole property to one single family, let's say this is again as an example, $500,000 property, which is a standard. Let's say it's a standard 4 bedroom, two bathroom, and instead of getting $500 rent on this. I could probably rent it room by room as long as I, go through the right way, the process to convert that property into a rooming house. I could let that property into a rooming house, which means I can put four different unknown people in each room. It's like a boarding house style. So, and I can get rent from each room essentially as opposed to the entire house. So what that does is instead of $500 a week to one single family, four different people are paying me the rent a week, right? Of course, that includes
Wow.
probably $300 a night, $250, depending on the area, whatever that is. There are a lot of people, singles and divorcees, and of course, youngsters, retirees who really want that type of a small space. They don't like big spaces. They can rent spaces like that, and in the right location, it can be a really good strategy as well. So instead of getting a $500 rent on the entire property, if you're getting $300 per room, that's $1,200 a week instead of $500, right? Of course, there's additional cost maintenance to be factored into all that, but it still yields a great return as compared to a standard let as such. Of course, you have to go through, the legislation just to make sure it is compliant, it is council compliant, and the building is compliant to Class 1B, which is what the rooming house is dictated as. So there's a bit of work that needs to be done on existing one, or you can even build new ones as well. Both states allow you to do that.
Hmm.
Legislation is different in every state, but it's a great strategy, for someone to look at commercial outcome type of cash flow as opposed to, in a residential sector. So to give you an example, we bought a $350,000 property, but maybe just on COVID for a client, 4 bedroom, one bathroom. We turned that into 5 bedroom, two bathroom essentially. So we added a bathroom. We turned the living room into a bedroom. And then once the work's all done, there was a license to operate as a rooming operator. And from the council, the building works were approved, and pretty much, it was given to the local specialized company who would manage that property, and they basically manage the entire thing. People coming in, going out, like it's like any other hotel, and the leases are there for maybe 2 months, 3 months. Some people even choose to live over 6 months or a year or plus, but that's onto an individual. So all that gets managed, by the specialist, and then um, the return from that, a total expense of 450K on 350K property, sort of yielded around anything between I think 12 to 15,000 positively gained property, about a couple of years ago. So it's a great strategy. Plus, you've got a land content, you've got the house. The growth has been phenomenal as well. That property is now nearly 500, 550K in the market. Of course, you could sell it as a commercial proposition as well. Um, the banks are getting aligned with the rooming house style type of lending as well right now. But all this is changing based on how people want to live, where they want to live, and really that shift is happening with more the doors to rent, the more money is in your pocket.
Excellent. No, thank you for sharing a lot of details on positive gearing, negative gearing, different type of property assets. I guess it's time to wrap up the call. Any parting comments you have for people who are considering to buy from a do should they be waiting till February, as you said, when the interest rates are coming off as expected or predicted, or really have a chat to their brokers and accountants about the strategies?
Yeah, look, I would just say that today is your time to really seize today's price, because the last time the property was really cheap was 20 years ago. So, and the next time it is today. So it's not going to get any cheaper. If you're finding some distressed properties just because of sales that are happening, that's okay. That's a different thing. But in most cases, the growth is going to continue happening. Australia is beautifully aligned with a lot of migrants coming in this country. Supply demand is always going to skew with more demand for the right type of areas and right markets and right properties. So do your numbers, get market. If you don't have not worked out your finance, get your cash in order, and I'd say probably speak to a professional to really understand what your goals and strategy would look like before you're going to execute that. And that can speed up your process, that can help you talk to the right professionals, rather than spending days and hours talking to different people, you go to one point of contact and you can get a lot of the information in one place. So yeah, but take action.
Absolutely. Thank you so much, everyone who tuned in, and thank you, Anubhav. Hopefully, the session will be very beneficial to whoever listens to it offline as well on our socials and the YouTube channels we maintain. And please, we look forward for a lot of your contributions. Anyone who is a professional following the page and would like to come online in one of the live sessions, bringing a broker, accountant, builder, landscapers, conveyancers, anyone, please ping me or Anubhav, and we will be very keen to get you scheduled on one of these calls. Thank you.
Perfect. Thank you very much, Puru, for having me.
No problem. Bye.